Assalamu alaikum class. In this lecture, we will discuss a very important aspects of business finance. In fact, a very important function of business finance, that is analysis of financial statements of a company. And we will do it via ratio analysis. Ratio analysis basically is a very powerful tool in financial analysis that helps stakeholder to understand the financial health of a company. The financial health means we are talking about the financial position of a company as well as the financial performance of the company. We have divided total ratios into five different categories: liquidity ratios, assets management ratios, debt management ratios, profitability ratios, and market value ratios. Liquidity ratios give an idea of the firm's ability to pay off debt that are maturing within a year. Within a year means we are talking about short term debt paying ability, or all those debt that is due within one accounting period, say within 1 month or 2 month or 3 month, current liabilities. So we are talking about current liabilities, whether the company has ability to pay its current liabilities or not. Then the next is asset management ratios. Asset management ratio give an idea of how efficiently the firm is using its asset. Assets mean both assets, the current assets as well as the fixed assets and the total assets. Whether the company is efficiently utilizing its assets or not. Whether the firm is efficiently utilizing its asset, converting into revenue or not. So assets management ratio is about the efficiency of firms' current, fixed, as well as total assets. Then we have debt management ratios. Debt management ratio, which give an idea of how the firm has financed its asset and as well as the firm's ability to repay its long-term debt. Long term debt means the debt which is due after 1 year, like 2 years, 3 years, 5 years, 10 years. So, debt management ratio is about the firm's debt paying ability, long term debt paying ability, whereas the liquidity ratios is the short term debt paying ability. Then we have profitability ratio. Profitability ratio shows the company's financial performance. Means this these set of ratios give an idea of how profitably the firm is operating and utilizing its assets. Here we will use the concept of net income as well as operating income, the EBIT, the earnings before interest and tax. Then we have market value ratios. These ratios are very important for from the investors point of view, the current investors as well as the potential investors point of view, the current shareholder or the potential shareholder. These are the five sets of ratios which we will discuss, which we will calculate and discuss the impact of each ratio on the financial performance and or the financial position of each company. For this, we have the book Fundamentals of Financial Management by Brigham Houston, and chapter is chapter 4. The problem number is 4-23, ratio analysis. The company is Berry Computer Corporation, the Berry Computer Company, and the requirements are calculate the indicated ratios. This problem basically asks few ratios, but we are going to calculate all ratios, all five sets of ratios, and then the second requirement is to construct the DuPont analysis. So we will also do the DuPont analysis in this particular lecture, and then we will discuss the strength and weaknesses which are revealed by the ratio analysis. So this is all our today's sequence of the lecture. First, we will calculate ratios, and then we will discuss or we will interpret the ratios. Then we will do DuPont analysis. Here you can see the balance sheet of the Barry computers as on 2021st, December 31st, 2021. Amount are in thousands. Then we have, you can see asset side, we have total current assets, which is 6,55,000. Then the fixed assets are 2,92,000, and then total assets by adding current and fixed assets. On the other side, we have current liabilities, which are 3,30,000. Then we have long-term debt, then common equity is given, and the total liabilities and equities are given, which are equal to total assets. Both sides are equal. This means that this is your balance sheet. That's why we call balance sheet a sheet which has uh, which both sides are equal. Then income statement is also given of Berry computer. You can see we have sales 16 lakh 7,500, then cost of goods sold, which is 13 lakh 51,000, gross profit, selling and marketing expenses are there, and EBIT. This is EBIT. EBIT is earnings before interest and tax, or this is also called operating income. Then we have interest expense and the net income. Net income is there, sales is there. So here we have Excel sheet for calculating the ratios. You can see I have divided all ratios into five different classes that we have just discussed in the slides, and then DuPont analysis. So this is the flow of our lecture. So class, I have copied the problem from the book here on Excel. Now the first ratio is current ratio. So current ratio is calculated by dividing assets by current liabilities. So current assets, we can see where are the current assets. So total current assets are given 6,55,000, and total current liabilities are here 3,30,000. So current assets are 6,55,000 dividing by current liabilities, which are 3,30,000. So the current ratio is 1.94 times. So the ratio is 1.98 times. Okay. This means the company's short-term debt paying ability is good because the company has 1.98 times current assets as compared to its current liabilities. The company has more current assets to pay off its current liabilities. This ratio should be more than 1. If the ratio is more than 1, this means that the current assets are sufficient to pay its current liabilities. The other ratio is quick ratio, current assets minus inventories divided by current liabilities. So we have inventories. You can see that here. These are inventories, then these are current assets, and these are total current liabilities. So Current assets are total 6,55,000 minus inventories are 2,41,500, and then uh, current assets minus inventories divided by current liabilities, which are 3,30,000. So uh, you can see 1.253 times, 1.253 times means the company has sufficient current assets minus inventories to pay off its current liabilities. 1.25 times more current assets minus inventories are available to pay its current liability. Basically, quick ratio measure the firm's ability to pay off short-term obligation without relying on the sale of inventory, because inventories are obviously a moving item as compared to other current assets like cash and receivables. It is less liquid as cash and receivables are. So the quick ratio basically shows the short term debt paying ability without relying on inventories, which is in this particular problem is 1.23 times. So this quick ratio, or the company has debt paying ability 1.23 times more as compared to current liabilities. So it should be more than one. Then the short term or liquid position of the company is good. The second set of ratios are asset management ratio. The first ratio is inventory turnover and is calculated by cost of goods sold divided by inventories. So we have this one, cost of goods sold. 13,51,000 is our cost of goods sold, whereas inventories are 2,41,500. So we can calculate it. Uh, Cost of goods sold, which is 13,51,000, divide by inventories, which are 2,41,500. So the inventory turnover is 5.94 times. Inventory turnover 5.94 times means that um, 5.54 times the inventory is turned over into sales, or the inventory basically turnover into sales. You can say the inventories during the entire year, the inventories are converted 5.59 times into cost of goods sold. The next ratio is day sales outstanding, DSO, day sales outstanding. And the ratio is uh, say receivables divided by sales over 365 days. Sales over 365 days means sales per day. We have 365 days in a year. So when we divide total sales by 365, we get sales per day. Receivables, let's check the data. Receivables means accounts receivable. We have 3,36,000 accounts receivable, and total annual sales is 16 lakh 7,500. So receivables are basically 3,36,000 divided by sales per day. Total sales are 1,607,500. So we will divide it by 365 to convert it into sales per day. And the answer is 76 days. These are days. Basically, this represent, we can write it like 76.29 days. DSO. In simple word, we can say that these are the days, on average, the sales the credit sales basically converted into cash. This 79. It was, I think, 79. We can calculate it here. 76 days. So your credit sales are basically converted into cash on average within 76 days. Basically, this sales represent credit sales, as we don't have credit and cash sales separately. So we consider this was 16,7,500 as a credit sale. The credit sales converted into cash in 76 days on average. The next ratio is fixed assets turnover. And the formula is sales over fixed assets. So we have this net fixed asset, and sales is here. So we divide this fixed asset. Fixed assets are means sales over fixed assets. So sales are 1607,500. Divide by fixed asset, we have 2,92,500 fixed assets. So answer is 5.49 times. 5.495 times. Basically, this ratio, the fixed asset turnover ratio, represent the how efficiently or effectively the firm is using its fixed assets in getting or in generating sales revenue. The next is total assets turnover, and the ratio is sales divided by total assets. So the total assets we have 9,47,000, and the sale is same. Now sales is 16,07,500 divided by total assets, which 9,47,500. So the ratio will be 1.696 times. 1.696 times. We are using or utilizing our total assets efficiently because the sales are 1.696 times of the total assets. So we are utilizing total assets effectively or efficiently. This means that the turnover of all of the firm's asset into sales are 1.69 times. We are utilizing it efficiently. Or you can say the sales are 1.69 times more as we invested in the total assets. The next set of assets are basically debt management ratios. And we have two ratios: total debt to total assets and time interest earned ratio. So total debt to total assets ratio represent This basically the use of debt will increase firms ROE if the firm earns more on its asset than the interest rate it pays on debt. It shows the leverage of the company. So we have two type of debt management ratios: total debt to total assets, number one. This ratio represent measuring the percentage of the firm's capital provided by the debt holder. That how much assets are financed by debt holders or the external liabilities. So total debt divided by total assets. So the total debt. Total debt is basically calculated by adding notes payable and the long-term debt, because notes payable is also a type of debt. This is not a operating liability. This is non-operating liability. So this comes into the definition of long-term debt, a debt, into the definition of debt, although it is a short-term debt. So we get total debt by adding notes payable and long-term debt. And total assets are given. mm, these are total assets. So first we calculate total debt. Here you can see this one. So total debt is the notes payable plus long-term debt, which is 2,56,500. Here it is long-term debt. It is mentioned in the balance sheet, and notes payable is also mentioned in the balance sheet. By adding these two, we get total debt, and now total debt will be divided by total assets, which are 9,47,500. So 9,47,500. So the answer is 0.359. Generally, we write this into percentage. So we can say that 35.93% means total debt. Basically, total debt is 35.93% of the total assets, or in other words, or in simple word, you can say that total assets are financed by total debt, 35.93%. So total assets are basically 35.93% financed by total debt, or the external debt, or the external investments are 35.93%. Now, time interest earn ratio. Time interest earn ratio is EBIT, is calculated by dividing EBIT by interest. So EBIT is, you can check, earnings before interest and tax is 70,000 EBIT, whereas interest expenses or interest charges are 21,000. So EBIT is 70,000 divided by interest expense, which is 21. So the answer is 3.33 times. 3.33 times. This means that operating income is 3.33 times more than its interest expense. Basically, this ratio measures the extent to which operating income can decline before the firm is unable to meet its annual cost. The failure to pay interest will bring legal action by the firm's creditors and probably result in bankruptcy. So this ratio should be more than one time. So here the company shows 3.3 times, means the company has interest paying ability 3.3 times more than the required amount. 3.3 times means the company's EBIT is 3.3 times as compared to its interest charges. So this 3.3 times represent the company's debt management ratios, or the company's times interest earned ratio is good one. The company's you can say debt paying ability is good, or interest paying ability is good. Then we have the next set of ratios are profitability ratios, which are related to you can say which are related to financial performance of a company. The first one is operating margin ratio, which is EBIT divided by sales. So sales is 16,750, whereas EBIT is 70,000. So EBIT is 70,000 divided by sales, which is 160,750. We usually represent profitability ratios into percentage. So we convert this into percentage, means we have 0.0435. So when we multiply this amount by 100, the percentage would be 4.35%. Means that the operating margin or operating profit is 4.35 times as compared to sales. The next is net profit margin, which is calculated by dividing net income by sales. So net income is this, sales is this. Net income is 36,750 divided by sales, which is 160,7500. Again, we represent this ratio into percentage. So the percentage is 2.286. This means that the net income is 2.29% of the net sales. The next ratio is return on total asset. So net income divided by total assets, how much the company is getting, how much income the company is getting as compared to total assets. We are comparing this ratio uh, on the basis of total assets, means the percentage of return on the total assets. So the net income is, you can see, 36,750. We divide this by total assets, and total assets are 9,47,500. So 9,47,500. Again, this ratio should be presented in percentage. So the answer is 3.878%. So the company is earning net income 3.88% of total assets, or the total investment in assets. The next ratio is basic earning power. Basic earning power is EBIT divided by total assets. So EBIT here, earnings before interest and tax, EBIT is 70,000. So 70,000 divided by total assets. Total assets are same. We have just taken the amount, 9,47,500. So the answer is 7.387%. So the company is earning, and the company's operating income is 7.39% of the total assets, whereas company's net income is 3.88% of the total assets. Then the last profitability ratio is return on common equity, and return on common equity is the formalized net income, which is net income is 36,750 divide by common equity. Common equity is a part of balance sheet, so we can find out that common equity 3,61,000. So here we have 3,61,000. So how much company is earning on its common equity? The answer is 10%, 10.18%. So the company is making 10.18% net profit on common equity, whereas the company is making 3.88% profit on its total asset. The next ratio is market ratio. So in market ratio, we have price earning ratio and market to book ratio. And we will also calculate earning per share. So the price earning ratio is price per share. Price means market price per share divided by EPS. So we need EPS or earning per share first. Earning per share ratio is net income divided by total shares outstanding. So net income is, you can see, 36,750. So net income is 36,750, and total number of shares outstanding, you can see, you can check the balance sheet. 36,100 shares are outstanding. This is given on balance sheet. So the number of shares are 36,100. So EPS or earning per share is $1.018 per share. And we can check it because this amount is given on the balance sheet in the question. Earning per share 1.018. So this amount is calculated in this way, means the company is earning 1.01 per share outstanding. The per share is issued. So this is the company's earning as compared to total shares outstanding. The next ratio is price earning ratio. Price means market price, and market price is given. Here you can check price per share on December 31st is $12. So price is $12 divide by earning per share EPS. We have just calculated 1.018. So answer is 11.78 times. The price earning ratio is 11.18 times. Means the market price is 11.78 times higher than its earnings per share. So price earning ratio is very good for berry company. Uh, this ratio also shows how much investors are willing to pay per dollar of reported profit. In simple word, the investor are willing to pay 11.78 times more than that its earning per share. The next is market to book ratio. So market price is 12, whereas book value, uh, price per share is 10. Okay, so 12 divided by 10 per share. So the simple is 12 divided by 10. Answer is 1.2 times. 1.2 times. So market value of the share is 1.2 times higher than the book value per share. So these represent market ratios. The next analysis is DuPont analysis. So DuPont analysis is basically we are trying ratios together. It is the formula that represent that how all the ratios work together to determine ROE. ROE means return on equity. So we have different sets of ratios for the calculation of ROE. uh, these are basically three different ways to calculate DuPont analysis. The first way is net income divided by sales times sales divided by total assets times total asset divided by total equity. So uh, net income divided by sales. So we have net income. So, in order to calculate ROE via DuPont analysis, first of all, we need net income. So, net income is 36,750. To we take net income, which is 36,750. Then multiply sales, which is 1607 500, and then multiply total assets, which are here you can see 9,47,000, 9,47,500 divided by sales, which here it is in the formula sales times total assets times total equity. So sales are total 1607,500 multiply by total assets, which are 947,500, and multiply by total common equity, which is 3,61,000. Here we have total common equity 3,61,000. So the answer would be this one. Return on equity is 10.5%. one 10.18%. If we write in percentage, we can say it is 10.18%. Here it is the answer. Uh, so return on equity is 10.18%. We can check it by another formula, which is profit margin into total assets turnover into equity multiplier. So profit margin, we can check it. Profit margin, we have already calculated. Profit margin is 2.29, 2.286%. So 2.286% multiply by total assets turnover. So total assets turnover are here. You can see 1.696 times. So total assets are 1.969 times, and then multiply by equity multiplier, which is total assets divided by common equity. Total assets divided by common equity. So total assets are 947,500 divide by common equity, total common equity, which is 361,000. So you can calculate this. So next step is to calculate ROE by another formula, and you can see the answer is the same as we used or we calculate via first formula. The answer is 10.18%. And if we use second approach, the answer is again 10.18%. And the third way of calculating ROE in DuPont analysis is ROA, return on asset, multiplied by equity multiplier. We have calculated return on asset is this 0.038786. 38786. So RO is 0.038786 multiplied by equity multiplier, which is total assets, which is 9,47,500 divide by total equity 3,61,000. So another way of calculating ROE is the third way, which is 10.17%. Why it is 17%? Because we have taken less digit. If we take 76387628, let's check if we write it 28. So the answer is same. You can see the if you take full digit to 8, the answer would be exactly same as in the first approach, second approach, or three approach. Basically, in DuPont analysis, we take all, we calculate ROE by three different approaches. Basically, we take all these three type market ratios, debt management ratios, and all together, and profit asset management ratio, profitability ratio, and market ratio all together to calculate ROE or debt management ratio. So this was the complete ratio analysis. We can check that the companies liquidity ratio, liquidity position, asset management position, debt management, all positions are good. The company has a strong financial health. The company has good profitability position or financial performance as well as financial position. So that's it from this lecture. Take care, class. If you have any questions, then please comment and like and share it.